Hi, everybody. Welcome to the 7 and 7 show with Zach Ellison. I'm here today with Stefan Whitwell, founder and CEO of Whitwell and Company, uh, based in Austin, Texas. And Stefan has a ton of experience on Wall Street, worked at Goldman Sachs, Credit Suisse, the CFA charter holder, has worked on the trading floor. He's worked in M&A, and a very, very smart investor. And so I'm really happy to have you on today, Stefan. Tell us a little bit about yourself, how you got here, and what you're working on now.
Well, I think my most important job is dad. I've got 4 kids and love being dad, but I also love, the world of finance, running Whitwell and Company. We're 14 states and all of our clients are just really different and accomplished, and it's fun to learn from them. I think it's also been especially fun the last 3 years when the world has kind of gone crazy and we've had a very new set of problems to look at and figure out how to apply kind of age-old principles to. I'd say 2 things I'm working on right now. One, and we can talk about it more later, but I don't think the banking crisis is over yet. I think it's going to create some challenges in the system that I'm interested in finding the right ways to take advantage of. And the second thing that I've been spending a lot of time on is thinking about functional automation, marrying the superpowers of humans and computers and understanding kind of where one starts and the other stops. And even the use of advanced automation, ironically, requires, in my experience, a tremendous amount of humanity, which is kind of ironic. And I think the effective use of AI does too. And so I've just been working on some projects related to that, and it's been fun.
Yeah, AI is certainly changing the nature of everything very quickly. And I'm thinking a lot about how it's changing the investment industry in particular. And within the RIA space, how do you think it's going to evolve, and what's it going to mean for advisors and how they interact with clients?
Yeah, I'm sure you do too, right? Every day I get tons of junk mail, people trying to sell me a new app, a new tool. And there's a lot of people that are trying to automate. So I think there's the investing side and the financial planning side. They're trying to automate both. I think it's really hard to automate the financial planning side. And of course, there've been a lot of people who tried. There've been some who've been very successful in the kind of automated trading space. But that's really, really hard. So at least for us, I think that where we see the most opportunity is looking at your workflow and going, what can a computer do better than I can? And also adding some discipline. So for example, thinking in a more disciplined way about data, making sure that you only enter data once, that you don't have multiple duplicative databases, thinking about things like, being able to automate intelligent kind of double checking of data or your systems and process, I think can be really valuable. The same way on the investment side, short of having the resources of Renaissance, I think there's some things you can do to automate kind of that first preliminary kind of data sifting that we need to all constantly be doing. And there's so much data out there that it's just impossible to try to keep up with it all as a human being in a manual sense. So I think there's a real race to come up with the most intelligent tools to isolate the factors or the developments or the changes in the market or data that are of greatest interest to you. And then I think intelligent systems, instead of forcing you to then go to that database and say, okay, what you got? The best ones are now proactively reaching out to you and saying, hey, knock, knock, guess what? Some interesting data is now that meets these criteria that you selected is now, happening. Take a look. And so I think ideally, one of the most low-hanging fruit use cases is just that, helping us kind of get through the massive data, isolating into the pieces that we needed then as humans be exercising our judgment and insight on, to then make the tough calls on the investment side.
Yeah, I agree. And I think about it a lot. And one of the things I think about is comparative advantage. And if you go back to Econ 101, when you were at Wharton and I was at Swarthmore, they teach you about comparative advantage. And the reality is that AI and computers are going to do things that we can't do, and they're going to do things better in some cases, but there's a lot of things that we will do better as humans. And yeah, I'm thinking it's going to evolve into almost like a very powerful tool that will enable us to take the low touch, repetitive activities off our plates and give us more time to spend with clients and deepening the relationships with them, and spend more time thinking about big picture strategic issues and less time on the day-to-day small issues that need to get done, but that quite frankly can be automated to a large extent. So I'm thinking hard about, okay, what does AI do better, and what can we use it for, and then take a lot of our work that we're spending time on and push that to AI, and then take that free time and use it for higher value activities. And when I think about wealth management, the highest value activity, in my opinion, is really that relationship with a client, right? And you know this well. I think you can not necessarily have the best financial performance, and if you've got a great relationship with your clients and they trust you and they know that you're always working hard for them and that you're doing the right thing, they'll kind of give you a pass at times if your performance lags a little bit for periods. But if you don't have that relationship, I don't think they're going to give you that pass. And so I think that'll be a very powerful tool for folks that utilize it wisely, right? Because it'll enable you to develop the relationship.
Well, I think you nailed it. There's this perception that it harms the workforce. I think it's going to change the workforce in a few years fairly dramatically, but I think it will, to your point, create a better pathway. So, for example, on our ops team, I would much rather have somebody on our ops team not having to manually enter data multiple times, but have a computer do that, which can do it much more perfectly, consistently, but free them up to do some things that they can still do better than a computer today. An example of that would be listening. Another example would be empathy. There's still an intimacy to the act of listening between two human beings, right? It's one reason we very rarely ever hear, and I'm going to generalize, but women complain about how great their husbands listen, right? I mean, he listens too much. You never hear that. He listens too well. Never hear that. In a client relationship, that's just crucial. And sometimes there's just that being present with that person and listening that creates that intimacy that a computer can't do yet, right? And so I do think it's going to enhance the quality of the time that we spend doing what we do. But I do think it's going to be very disruptive. I think it's going to end up creating a lot of job shifts that I think we in corporate America need to proactively try to figure out how can we help people adjust. So if we see people on our team whose jobs are, you can imagine, very replaceable by technology pretty soon, I think it's our responsibility to kind of think 2 or 3 steps ahead and go, hey, what is that person's superpower? How can I deploy them if we had technology today, which we will tomorrow, to do 80% of what they're doing today? And even from a client standpoint, I'll give you another example. We have a very automated onboarding process. And it all starts with a very interactive type form where the questions are highly personal and a dynamic to how you last answered it. And it's funny seeing the times of day or night that clients end up choosing to fill that out. And there's great freedom for clients in being able to do that on their time frame rather than having to do it at a scheduled meeting, sometime between 9 and 5, because I don't know, like most of us, we're just pulled in 1,000 different directions, and Our schedules can be very different. And so from a client experience too, I think it gives them the freedom to engage with us in sometimes more convenient ways as well. So I'm much more excited. I think there's a lot of promise there, but I do acknowledge there's going to be some change, and I think we need to try to get ahead of that in a conscious way and help in our companies create the smoothest transition for people as possible.
I've been reading some research recently coming out of some of the bigger consulting shops, and they basically say it's going to hurt white collar workers the most and senior white collar workers, meaning AI is going to replace or take some of the jobs away from those folks. I actually disagree, because I think where it's going to really have the biggest impact is the mid-level for white collar professions, but mid and lower level folks, because ultimately using Chat GPT and similar AI today, generative AI, it's basically able to do the work of, I would say, like a first year analyst. And just like a first year analyst work needs to be checked thoroughly by more senior people, so does Chat GPT's outputs, but it's so much faster than a first year analyst and has a much greater scope where it can suck data in instantaneously. And so what I think will wind up happening is teams will get a lot leaner in the middle and lower ranks. And I still think there's going to be the need for senior people that are making the big picture, strategic decisions. I don't think you're going to outsource your CEO's job to AI, but I do think you're going to outsource your mid-level manager's job to AI. And anybody who's doing functions that are repetitive and, quite frankly, like don't really change day to day, that's all going to be automated. Anything that changes is going to be difficult to automate. But if it's the same process, like in trading, for instance, there's processes that are the same every single day. Why is a human doing that? That should be automated. And so I think that's what will happen in my view. How do you think about how it'll affect the workforce?
No, I think that's right. I think what's going to happen is, like right now, there's this explosion of curiosity, around the different AI programs that have gone public, and actually, if you look at their the speed with which they've gotten their first million users, it's faster than any other app in history by a long shot. It took it like 6 days to get its first million, users or something crazy. But there's resistance to change is slow until you realize you have to, and then it can be very quick. So I'll give you an example. I have a friend who was told for many years, oh, you need to eat better. You got to watch your cholesterol. Didn't change. Or if he did, it was very minute. Then he had a heart attack. And then overnight, he became vegan, super clean eater, right? Because he had to. I think what's going to happen is there's we're going to see a lot of larger corporations kind of be slow to really fully harness the power of automation. But then they're going to get hit with by competitive pressures of firms that are able to just run circles around them at a fraction of the cost, and they're going to be forced to do that. And so what I fear is that there's going to be a point where there'll be an accelerated amount of change if we're not proactive ahead of time. And I'll give you an example in the financial industry. Where is the innovation taking place? It's not happening at the large banks, at the large brokerage firms, in part because they're saddled with decades of legacy IT systems that are just a mess. And they're also not known to be kind of, great centers of innovation to begin with. It's the smaller firms that are saying, hey, I don't have the resources to hire 10 people. How can I get this done? I want to compete with that firm that's 10 times bigger than me. What tools do you have that can help us, right? So what's that quote? Invention is born out of,
in necessity is the mother of invention.
Yes, yeah. That's right. Yeah, that's exactly right. So I think that it's going to creep up on medium and larger size firms faster than they expect, but not immediately. Larger, it's just people are, there's a lot of resistance to kind of wholesale change. It takes great courage to be able to identify, like if you're managing 50,000 people, between you and I, there's probably 10,000 people's jobs that could be completely reinvented. But it's really exceptionally rare when you have a leader who's willing and able to kind of take that on at scale on the front end. So I think it's going to creep up on a lot of firms. But if you embrace it, I think it can create a more human experience, ironically. And that's what I want. I don't want to, I don't have a great experience interacting with some of these crude chat box things. Like, I'm the guy that's like, get me on the phone with a human, right? I don't like these automated phone systems where it's like, hit 1 for this, hit 2 for that. And I'm the guy hitting 0 like 30 times. Get me a human being, you know?
Oh, I'm in the same boat. And, it's funny. People often ask how ARI got its name, Applied Real Intelligence. And this started about 5 years ago when I was thinking about the company that I wanted to build. And at that time, AI was certainly used, and my view was that what's happening today was inevitable, and so I knew this was coming, right? It was inevitable, and my view is that back then you would essentially have to say what was AI driven, because there was only 3 to 5%, let's say, of interactions were AI driven, and people didn't necessarily know this, but news outlets like Bloomberg, for instance. As early as 2016, I was meeting with senior people at Bloomberg, and they let me know that approximately 10% of the articles were generated by machine. And I thought, wow, that's pretty interesting. What are you guys doing in the bond markets around that? It was all for stocks. And they actually, they were like, nothing. We're just, it's all for the, equity products. And I thought, wow. And so I went back to my firm and I actually built my own, and I generated a newsletter that I sent out every day it was probably 80 or 90% automated. And I'd basically suck in data via API on Bloomberg, and I built an algorithm, and basically the text would be generated based on the numbers. And so people were reading this every day, and it was one of the most read newsletters in the markets by professional traders. And they're like, how do you do this? Like, how do you get this out? That's like set 6:37 in the morning. Do you start at 3 a.m.? Because it was like 10 pages. And they didn't even know that, this is the first time I've told this to anybody publicly. Like, little did they know that 80% of that was auto-generated, right? And so to go back to how ARI got its name, my thinking was that back then you'd have to say, okay, this is AI generated, right? Like when you call it Bank of America, and you get the prompts that don't work, and you're like, okay, this is AI now. Or you'd be in a chat conversation with some software company, and it's like not answering your question, right? And that was clearly not a human, and it wasn't effective, and it was like pretty much garbage, and it was so frustrating. And I thought, well, fast forward 10 years, probably 95% of everything we do is going to be related to AI in some way, commercially, and we're going to have to differentiate what's not AI. And we're going to have to say, this is a human you're talking to. This is applied real intelligence. This is not AI. And that was really how this name was born. It was the fact that I knew this was coming, and I wanted to differentiate and say, okay, there's going to need to be a term that people use to differentiate what's not AI. And also add to that.
I hadn't thought of that distinction, but that's a neat, That's a really great point. Because you're right. It's going to become the dominant majority, and then we're going to be wanting to know, well, where's the real intelligence? Hey, one thing just to add real quick on the automation front. The other thing that I think is going to temporarily slow it down before it then goes light speed in its acceleration is when we first started. When I first started getting into automation. I ran into an initial brick wall that I wasn't expecting. And that brick wall was, if you have automation, in theory, it helps you scale and go quicker. That's assuming that you have a very defined process. And if you would have asked me prior to beginning that kind of internal experiment, do you have a process? I would have been like, yes, I absolutely do. But it was only when I had to program things in black and white rules that I realized, well, in this scenario, we don't actually have that defined. In that instance, we haven't actually defined that. It was a very humbling process, very healthy, very thought-provoking, very strengthening. But I think it will expose a lot of companies parts of companies' process that are just not defined at all yet. Because without that being clearly defined, you have nothing to automate, right? And it was very humbling to realize how much we thought we had a real process, but didn't really actually have it completely defined, if that makes sense.
100%. And, I'm incredibly process driven, and going through exercises like automating a newsletter, 7 years ago, taught me that. And I'm not a coder by any means. I just taught myself. And that's how we think about investing too. There's an art to it, but there's also science, and really you need to combine both. And on the quantitative side, you should be very, very process driven. And then of course there's going to be a lot of judgment calls you have to make. But if you can take the quantitative side and automate a lot of that and be very, very process based and rule based and consistent, that then is very additive to the qualitative judgments you're going to make. It essentially takes a lot off your plate and can allow you to think about the most important things that are not necessarily black and white, but that are always some shade of gray.
Well, it also forces you to confront important choices that otherwise can get swept away in the sea of time, because we get so busy that things can just escape us. And so the other benefit of rules like that on the investment side is it forces you, hey, price violated this, or this, boundary got broken, forces us to then have a conversation and deal with that in a really healthy way. And that's something I think that, again, is a plus of automation, a plus of what computers can do, is they're not emotional. They will tell you when that condition is met.
So this leads nicely into my next question, which is, what are the key investment principles that you live by? And you maybe loop that into how you think about process-based investing to some extent.
So I wrote a couple down here, and I'm going to share them with you. I'm not going to actually many of them I think are ones you probably share or have heard of, but just in the spirit of sharing, there's some big lessons that I've learned over time, and ones they don't always teach you at Wharton or in the CFA program. So first, I'd say, it's better to be rich than right, at least in the world of investing. I think investing, one of the things that I really admire about investing is it promotes humility. And if you don't embrace humility and get over being right or wrong, then it can be a very expensive profession. Two, I would say, this also kind of confronts my traditional fundamental education. Price is the ultimate yardstick, for most of us. If you're Buffett and you have a 50-year time horizon, then that may not apply to you as much. But price is truth. And I struggled to kind of accept and understand that until I started trading futures, where risk management becomes, the difference between life and death. And, what I learned was, you got to first pay attention to price and take action based on what's going on. You can then get intellectual and analyze and study and understand and all that later, as long as you're still alive. But staying alive, it's almost like speed in a car, right? If you're going around a corner, there's just certain boundaries that you need to learn to observe and pay attention to, and how you manage risk. Third one, kind of related to that, would be cut your losers fast and let your winners run. And we say that in the financial sector, but I hear CEOs say that about how to manage employees on teams all the time, right? If you ask, a CEO of a Fortune 500 company or even a smaller company, offline, what some of their biggest lessons learned, many of them will tell you, hey, you know what? It's when you realize somebody's not the right fit on a team, taking action fast. There's so many stories that you hear from seasoned CEOs about how they just tried to help, took forever, and it just caused all these other issues. I think that's something we've got to practice in the financial space as well. Another thing I would say is observe before judging, which I think would be a great lesson for modern American adults in culture today in 2023. observe before judging. And that goes back to price, right? I think it was, I'm forgetting his name. Oh, Charlie Munger, right? So Warren Buffett's partner, who talked about scotoma, the fact that neurologically we look for evidence to support our views. And so I think, one of the other disciplines of investing is learning to, as best we can as humans, try to discard our biases and really try to see what is there. And sometimes what's helpful for that is to look for evidence contrary to your view. So for example, in my inbox, if I'm just getting flooded with articles and some of those articles are about a position that we own, I will often ignore the good articles and I will read the ones talking about how, that particular security is bad or going to fall or got a sell rating or something with it. I will read those first as just a discipline to make sure that I'm not getting caught in my own biases. Another one that I think we can credit Warren Buffett for, I don't know if he actually said this or it's just street lore, but be greedy when others are fearful and be fearful when others are greedy. I've seen opportunities time and time again, some of which I've taken advantage of. Others I look back on, I'm like, damn it, I really should have, listened to my gut and taken advantage of that market extremity, whatever that may have been. Easier said than done, but there's great value when you can remember that at points of extremity. In old sailor lore, we always used to say it's always darkest before dawn. And I think that's true in the markets. Another one would be, and this goes back to our kind of AI discussion, but create a plan and then work it. It helps manage the emotion. We're not going to be perfect. And there are things that are going to require human input. But I think a good plan gives us the discipline to make sure that we're asking the right questions at the right time and having those tough conversations. Another one that is just so simple, but so true. And many of us who've traded futures have learned the hard way before really understanding its wisdom, is don't fight the trend, right? The trend is your friend. And that again goes back to, it's better to be rich than right. We get a point of view, we're like, dollar yen should be falling or it should be going up, and starts going the opposite direction. You start increasing your positions. And why? Because you're convicted in your point of view rather than paying attention to what's actually happening in the world, and end up getting on the wrong side of trend, which can be very, very dangerous.
Wow.
Another one that just one other one here, inspired by my grandfather. My grandfather was born in 1899, grew up in the Great Depression, and he never bought anything on credit. I wish I could say the same. He bought everything all cash, very, very conservative. I think they kept every nail and screw and piece of wire, jars in their basement till the day they died. But, leverage can be very positive when used judicially, and leverage can work against you very quickly if you're not careful. So I think leverage, you just need to be extra thoughtful when it comes to leverage. I see in real estate all the time, I'll see people go, oh, here's a great deal. It makes 9%. No, it's actually, a 2.5 cap rate levered to the chin. I'd rather have a 6% return unleveraged. I can always add leverage later. So kind of looking at things pre-leverage and then understanding when it's super advantageous to add it, and when you want to, maybe take a pass on it. And then the very last thing I'd say, just kind of, we're human, right? And there's always, this inner fear of missing out, FOMO. We even have our own name, right, in finance for it. I think that's another emotion that as a professional investor, we need to really guard against. And I think right now is a great example of that. The market's gone up a bunch, really on the back of 7 stocks. A lot of people did not participate in that, and had bad years last year. So there's a sense of like, oh my gosh, how do I make up for it? Right. And that can lead to really bad decisions. So, I think it's just important for investors to recognize when you're feeling that, just acknowledge that and put it to the side and go back to kind of your plan. So those are some ones that for me are some really profoundly powerful lessons that I've learned from others, and some I've learned the hard way, and continue to be important to our thought process today.
Those are such good points, and there's so much I want to dig into there. We could probably talk about it all day, but you nailed it. I mean, those are just all great points, and the idea of FOMO I'll touch on just because it kind of answers a question I was going to ask you, which is one of the biggest mistakes, or what are the biggest mistakes is the question. And in my view is that FOMO and getting in at the wrong time and chasing the shiny object, chasing the hot trade, it just blows people up, and they do it again and again and again. It's like, why do people not figure this out? Now, I'll give you a quick little anecdote that I think, I don't know, I find it amusing, but let's see what other. So when I was a kid, I used to collect baseball cards and other sports cards, basketball, football, and a huge collection. It was my thing, right? And when I was young, there was this magazine called Beckett's, which would give you the price of all the cards. And so it would come out once a month. And I was 10 years old, and I'd go read it, and it would show you the price versus the previous month, and it would have a little arrow if it went up, down. And so what I would see is that there would be the hot players and the hot cards would have the little up arrow, and I soon realized, oh, this is not an indication of where the price is going to go. This is where it already went. And so I started as a third grader realizing that you shouldn't buy things that have already appreciated in value. You need to look for the cards to buy before they have the up arrow next to them. And I figured this out in third grade, and it was pretty obvious to a third grader, how this works. And yet the market, including institutional investors, still hasn't figured this out. They're basically buying after the up arrow has been printed in the magazine for 6 months. And they're like, oh, well, now I want in. And whenever I read prognosticators saying that people should buy into the market now because it's done really well, I want to call up their boss and say, can you just shut this person up and fire them? Because, I mean, this is complete nonsense. And yet the market has really, bought into this and thinking a lot. And I think this is, I do want to get into this because it's been something that's been bothering me, is the quality of investing out there has plummeted in recent years. Absolutely gone down the tubes. You've got meme stocks, you've got assets that aren't even real, and people think they're investors because they can speculate on their Robinhood app. And it bothers me because real investors have spent decades going to school, working at the top firms, working 60, 70, 80 hours a week to get better every single day. And we're true experts in our field. And then somebody comes along, and because they've got a LinkedIn account and they can spew their opinion, all of a sudden they think they're an expert, and somehow others do as well. And to me, the investment industry is at risk right now. And one stat I'll share that I think is very interesting. We're both CFA charter holders. CFA is kind of like the gold standard in the industry. And, there's many, thousands, tens of thousands of charter holders worldwide. I think there's, almost 200,000 now. Now, what's interesting to me is that the number of people registering for CFA exams has plummeted in the last 3 years. And it coincides with this boom in crappy assets and boom in liquidity. And it's gone down immensely. So the 3-year average number of enrollments for the CFA tests from 2017 to 2019 was a little bit under 250,000 annually, right? So COVID, about 250,000 people registering every year. Last year, 2022, it was down to less than 150,000. It dropped 2%, right? And the year before that, in 2021, because of COVID, only 50,000 people took the exam. So you would expect that the number would have went up in 2022 because of the pent-up demand from 21, right? Instead, it went down. And this year, the year-over-year run rate's lower than 2022. So what we're seeing is a massive decline in the number of people that are trying to participate in the CFA exams and earn the charter. And it's interesting to me because I think there's certainly a correlation there between the easy money that's been made and the amount of work that people want to put in to actually become skilled investors. And who wants to put in 1,200 hours studying for the CFA and probably not pass every level in the first attempt when they can just go buy, cryptocurrency or a meme stock or, an AI speculative stock, and all of a sudden, they've made, 5x their money. And I think markets, yeah. And so the markets got basically help people develop very, very bad habits. And I think we need a cleansing to wipe out those bad habits. And that's why I'm kind of rooting for, a reset.
Hey, you mentioned a couple interesting things that I want to hit on. So on the emotional side, I think one of the other key mistakes that investors make is they look backwards instead of looking forwards, right? This is one of the most fundamental mistakes that we saw happen at Silicon Valley Bank, for example. I mean, for 20 years, 25 years, owning bonds was an incredibly great trade, right? And then the Fed decides to start raising interest rates. They did not do that suddenly. They were on the top of a mountaintop shouting, "We're going to raise rates. We're going to raise rates." And it's amazing to me how many people, portfolios, strategies, models, all have a huge amount of bonds in them, traditional bonds, for no other reason than that's what we did yesterday. And I think that really hurts people. I think you've got to be forward-looking, not backward-looking. And to your point, in other areas of life, people are pretty good at this. They get that, right? So like if you're out driving today and it looks like the sky is just going to start pouring, that's what's going to matter to you, not the fact that yesterday it was bright and sunny. You're going to be forward-looking in terms of thinking about if there's super cold weather projected the next week in the city you're traveling to, you're going to bring warm clothes because you're looking forwards, not backwards, because last week you were in Maui on a beach and it was 80 degrees and wearing, a bathing suit. But yet in the investment space, it stuns me how much of the herd is still focused on yesterday.
Yeah, and this touches on the point you made earlier about resistance to change. I think the investment management industry historically has done well because they didn't change and they were kind of always that like steady rock that never did anything differently. But in the current world, things are changing so quickly, and so folks that don't adapt are going to get eliminated. It's going to be Darwinian, in my opinion. I think there's going to be a huge culling of all the folks that are resistant to change. Work the change because they'll go out of business. And I think we're going to see a big wave of that over the next 5 to 10 years when a lot of mediocrity is wiped out and folks that aren't skating to where the puck is going, as Wayne Gretzky would say, they're just not going to have a seat at the table anymore. And
banks, I think, are going to be at the center of that. And there's a few things on that I want to share. But one other thing I want to add on the topic of human capital. I had a breakfast, I don't know, it's probably 15 years ago. I was invited to a relatively small breakfast hosted by Michael Milken. And at the time, it was, again, kind of one of these periods where we had twin deficits and everybody was freaking out. Is the sky falling? Is America going down the tubes? And nobody had asked him about that yet. So I did. And his answer was really instructive to me, very insightful, very deep, and inspires me to this day. He said, "I don't worry about the financial deficit." He said, "I worry about the human capital deficit," right? If you look at the history of the country, some of the great things we did were powered by extraordinary intellects that we recruited to America that made America home. Immigration had a large part to do with that. We want to make sure we are, in a healthy way, inviting the right people to make this home. And when I think about, some of what we're seeing in the marketplace today, I think there's a lot of thought being given to the financial capital side of the equation, but not enough being given to the human capital side of the equation. And so I think that there's going to be a lot of disruption, but an enormous amount of opportunity. And like I said, I think banks are going to be absolutely at the center of that.
So much good stuff to talk about here, but we only have a few more minutes. So I want to use this as a segue into talking about alternative investments, because that is where the world is going, and that is in the investment industry, certainly. And I'm curious, why do you think alternative investments are gaining popularity, and why are they very beneficial to have in one's portfolio, generally speaking?
I think two reasons. One is experiential, the other substantive. From an experiential standpoint, a lot of clients, what they don't like about the stock market is the fact that, multi-billion-dollar companies could be up or down 25% a day. And that kind of roller coaster, was cool when you were a kid in an amusement park, but it's not cool when that's your net worth that is, experiencing such dramatic fluctuations. And in the private markets, alternative markets, I think that there's, in general, the experience is one of less volatility. There's still risk that you got to manage. And I think that's been a point of attraction. Substantively, with my CFA hat on, and this does relate to the banking crisis, there are opportunities to earn, very healthy rates of return on risk-adjusted basis in the private markets that are not available in the public markets. And so from an investment standpoint, it doesn't make sense to limit yourself to just one half of the menu. And the private markets have been steadily expanding over the last 20, 30 years. And today they are substantial markets. This is no longer a niche playing field. And a great simple example would be, you've got a lot of investors out there who are saying, hey, look, I want something that's going to be, I want to stay ahead of inflation. I want to make, high single digits, low double digits, but I don't want to bet the farm. Right. And so a lot of people have tried to accomplish that using leverage and investing in high yield, publicly traded securities, but that could be really risky. On the other hand, in the private markets, there are very attractive opportunities to do that on what I would argue is reduced risk basis that are created by imbalances in supply demand of capital. And the banking crisis we're seeing right now is a great example of that. Small, medium-sized banks are now incentivized to be a lot more conservative because they're worried about the prospect of a bank run. They don't want to end up without a job tomorrow. And as it is, their deposits are leaving them because people are waking up and saying, hey, I'm not okay with the national average of 0.4% that you're paying us in our savings account. I should be able to get 4.7%, without taking much risk, if any at all, in the right kind of money market fund. And so their deposits are leaving. Risk level, they're less willing to embrace any risk. And so you have a lot of companies out there and people out there that need access to capital. And in the absence of banks being your lending partner and providing that, niche lending opportunities, have existed and are now, becoming, I think, even more dynamic. And there's an opportunity to earn, healthy yields that, if you're organizing that fund the right way, you're not betting the farm. And so I think there's some really attractive opportunities there that, going back to your very, very first question, that's one of the things that we're spending a lot of time looking at is where are the best opportunities that are coming from this tremendous, credit reduction in willingness to provide credit, not just the interest rate, but just a willingness to lend, because banks are now kind of under, extra scrutiny by the regulators and fearing bank runs and worried about their profitability as they should be.
So this is a great tie-in to venture debt, which is what ARI does, in the sense that, well, first I want to go back to tying it in with Milken. So Milken became famous and rich because he basically popularized loans to non-investment grade companies, right? So back in the early 80s, a lot of folks said, why would you ever lend money to a company that wasn't investment grade? That's junk. And so it was known as the junk bond market. And what the reality was is that there was this huge percentage of the universe that needed this capital, and they weren't being efficiently served by that ecosystem, by the banks at that time. And so Mike Milken and Howard Marks and some others basically said, well, we're gonna help these non-investment grade borrowers access the capital markets more efficiently. And it was called junk bonds back then. Now it's called high yield, and almost everybody has it in their portfolio. And that's ultimately the opportunity that I saw and continue to see in venture debt. There's this need for capital from startups that are growing very fast. They've got revenue and they don't want to sell more equity necessarily, but they need growth capital. And so they'd like to borrow some money to help them grow because it's cheaper and less dilutive than equity capital. And so there's this huge growing pool of innovative companies. Like, think about all the startups in this world that are coming to market that are going to need capital. And there's two ways to fund them: equity, the VC model, or debt, the venture debt model. Now, on the venture debt side, it's very underserved, and there's very few players in the space. And that brings us to the next point that you just made, which is banks are pulling back on lending and providing less credit. And I think that's going to continue, which has created this huge market opportunity for non-bank lenders. But you have a question or thought?
Yeah, it's all kind of markets. So there's the venture debt, market is going to need capital. It can also just be saying, like, for example, the traditional banking credit model is really based on this idea of a credit score, right? Okay, if you have a perfect credit score, then we'll give you capital. The next level down is cash flow. So if you have really great cash flow, but you have a terrible credit score, think a wealthy doctor or dentist that's in the middle of a divorce, and there've been intentional, the complications between credit cards haven't been paid and all these things as part of that process. But the guy's making bank, cash flow is strong, but from a traditional credit standpoint, his credit might be terrible, right? So a lot of the traditional banks would look at that and be like, ooh, we don't want to touch it. So then that introduces, cash flow based lending, which, some banks do that, but a lot of them don't. And surprisingly, and then the third level down is collateral based lending. So, okay, you don't have cash flow, but you've got collateral. And so I think there's a rich opportunity based on different types of lending models. Banks are pulling back in all three. There's also speed, right? So banks are traditionally incredibly painfully slow to work with. Michael Milken, for example, innovated the allocation of capital, not just in the financial markets, but he also in the medical research space. I don't know if he wrote an amazingly inspiring book about that, where traditionally, if you were a young upstart researcher in the medical space, the applications for grants would all ask you to cite what books you've written, what articles have been published. Like, hey, I don't have any gray hair. I'm 25 years old. I just graduated with a PhD. I've got some really great ideas. I need some money to test them in the labs. I don't have 15 citations. And, even if they did consider your ideas, the turnaround time would often be a year. Milken came in and said, hey, we don't care about the gray hair. We care about the quality of ideas, and we'll fund you in a week. Can you imagine that, being a 25-year-old researcher, being like, yo, what? And so the, speed and the qualification process. I mean, he had experts evaluating the merit of the ideas. And in a portfolio of ideas, there may always be a couple that don't perform, which is why you always want to put a fund together so that you're diversified across those credits, so that invariably when some of those don't go according to plan A, you're still okay at the portfolio level and doing well. But I think there's a lot of, there's a lot of people that'll be happy to pay a higher premium for the convenience of, a faster decision process. It's the certainty of getting an answer, yes or no, rather than kind of this long drawn out process. The banks that can be agile and give that quickly, I think will continue to thrive. But I think many banks, a lot of the banking sector, that's just not their forte, and creates unique openings for firms like yours and other specialty lenders to take advantage of, and opportunities for us to deploy client capital in ways that are far more profitable, I think, now with that imbalance and with higher interest rates than they have been for years.
That's great insights, and I think a lot of people are still figuring this out, and it'll take them a while. So you're well ahead of the curve, I think, in terms of how you're thinking about it. So
backwards looking versus forward looking, right? I mean, it's easier for a lot of people to just we'll buy a 20-year U.S. Government bond ETF. Well, that was down 32% last year, right? Bonds are safe. We heard that for decades, but 20-year bond ETFs down 32% last year. Not safe.
So to add to that stat, if someone was invested in an average performing venture debt fund last year, they would have been up close to 20% versus being down 32% in the government bond. So think about that. They would have picked up 52%, which is basically a decade of fixed income returns in 1 year. So all the people that have been waiting, hey, I don't want to get into venture debt. I don't want to get into private credit. I just want to own these treasuries because they're, quote, low risk, didn't really contemplate interest rate risk and didn't really know what they were doing. And, now they're, going to be behind the curve for the next decade. And just to get back to break even, it's going to take them 10 years because they missed.
Yeah. And I think this is going to get even more accentuated by the real estate problems that are on banks' balance sheets, not to mention they're long a bunch of long bonds as well.
Mm-hmm.
I don't think real estate's out of the woods yet. I think residential is probably better positioned because, home is the new office. And even today, 3 years after COVID, the physical occupancy of our downtown office buildings in the top 10 U.S. metro areas hovers at slightly below 50%. But other, office buildings, oh my gosh, right? I mean, malls are going under, retail. Here's interesting. Only 25% of our retail business is done online today. In my house, it feels like 100 because of, Amazon. My wife is like, if they gave out like designations, she'd be like an Amazon ninja, I mean, and it's amazing what you get online now. But just 25%. So that 25 means the logistics and the office, the warehouse logistics behind that. Is 25 going to go to 100? Probably not, but is it going to go from 25 to 50 to 75? I would absolutely argue that it's headed that direction. So, there will be niche areas that continue to do well, but I think a lot of people are going to lose money in real estate. They've been raised on this idea that real estate always goes up, and they got raised in an environment where interest rates were, inexpensive and near free for a number of years. After tax cost of debt is 2 or 3%. I mean, it's just, and so you had a lot of people that were just buying stuff, leveraging it up and going, hey, it's always going to go up. I'm going to make a lot of money. And it did. Backward looking, forward looking, going forward, interest rates are much higher. Behaviors have changed, and you got to be smart about it. So, I think banks, that's going to also saddle banks, and that's going to create, again, more opportunities in the middle.
Yeah, you hit on an interesting point about the growth of the market potential going from 25% online, and it could easily be more than that. And that's what I think a lot about in terms of innovation finance, in the sense that only about 1% of total capital in the startup ecosystem is debt. So if you were just
right?
Yeah. So if you were to go from 1% to 2%, which is not 2% is not a big number. You literally double the size of venture debt in the ecosystem. And that's why I think this market's poised for huge growth, because if you look at the public markets, S&P 500 companies, for instance, 30% of their capital structure, a little bit more than 30% actually, is debt, right? And so obviously startups are never going to have as much debt as a mature company, but I don't think that, the difference should be versus 30%. So in my mind, that 1%, 5 to 10 years from now could easily be 5%, which means you've got 500% market growth. And that's why I see this venture debt market exploding in growth, just like high yield did, or junk bonds back in the 80s and 90s.
Yeah, and you may have the actual statistics on this. I don't remember off the top of my head, but when I was looking at the Silicon Valley Bank debacle, although I was incredibly shocked at the fact that nobody on their board or senior management seemed to be managing even the most basics of balance sheet risk with respect to their fixed income holdings. I do have to give them credit. When you looked at their venture debt portfolios, the credit losses were very, very low. They did at least from what I saw, seemed to do an exceptionally good job in that side of the business.
Yeah, it's a shame that they didn't know how to manage the rate risk in their treasury portfolio and mortgage-backed portfolio. But yeah, the jewel in their crown has always been the venture lending, and I always use that as a great comp when I'm talking to people about venture debt. I say, look, we can look at Silicon Valley Bank's numbers, and there's other public companies that specialize in venture debt, and the numbers are out there. And 2009, worst year in history essentially for financial asset performance, at least in our history, right, in our lifetime.
Right.
Silicon Valley Bank only had to write off 2.6% of their loan book. 2.6, wow. That means 97.4% of their loans were all performing and generating interest, and therefore they didn't even lose money in 2009. And I think their venture loans actually perform better than their non-venture loans, because venture loans are backed by the top VCs in the country, right? And so there's implicitly huge support and a lot of money behind these companies. And so it's not the same as lending to a traditional small business. You're not lending to a restaurant or a hairdresser or a lawn care company. You're lending to one of the fastest growing tech companies in the world. It's backed by big VCs. There's a lot of money that's gone into it, a lot of reputational risk, right? And there's a massive amount of skin in the game that's subordinate to you when you're the senior lender. Like, you basically control the cap structure as a senior lender, and everybody else that's put in money is subordinate to you, and you're going to get paid off first in a downturn.
Yeah, so that's another example of where I think there are niche lending sectors where there's something about it, the exterior, that scares people, and this being one of them. That if you structure it right on the inside, they're doing a lot to reduce risk, and it might be significantly more on a risk-adjusted basis attractive than people really realize. Another example of that would be like we've invested in dip financing strategies. It's a lot of people, they'd be like, why in the world would you ever lend to a company that's in bankruptcy? On the surface of it, that sounds crazy and risky. But, of course, when you dig into it and you see that you have no collateral risk because it's, there's total, clear, absolute title, thanks to the, power of the judge in that context, highly supervised process, usury rates don't apply, and you're over collateralized. Suddenly you start to think, that's pretty interesting. And also the only place on earth, by the way, where you get paid before the IRS. I didn't know that until we started doing due diligence on that. But if the company owes money to the IRS, they don't get paid until that dip financing does first. So again, to the outside world, it might seem like a really crazy, scary thing. But when you get on the inside and you look at all the different precautions and things that are done to manage that risk, and you start going, man, this is a lot better than some of those super volatile, high yield funds on the stock market. So I think that arbitrage of kind of emotional perception of what it feels like to somebody who doesn't know what they're doing versus being on the inside.
Well, a lot of people don't realize this, but the history of value investing, if you look at Ben Graham and who Warren Buffett learned from and really understand how it all began, they would invest in companies that they called cigar butt companies. Basically, you have a cigar butt on the street, but there's still like a little bit left to smoke, and you're picking it up for free essentially. And there's value there. Very similar analogy to like a dip financing, right? Where yeah, the company might be going down, but there's still value. And if you can extract that value and you pay the right price for it, you can be a big winner. And I think a lot of people don't understand that. They get they get these concepts of price and value confused. So I would tell people to go read up on Howard Marks and his views on price and value. And you'll learn.
He has some great quotes on that, doesn't he? I mean,
Yeah,
what a great mind.
yeah, brilliant. And kind of random thought here, but I think both Howard Marks and Mike Milken are also working grads, undergrad.
I don't know. Well, yeah, that's right. Yeah.
But Marks went to Chicago Booth, or the GSB, when he went there for business school. So yeah, I always like him for that as well.
A funny story about Milken. I was friends with his son, Greg. We were in Japanese class together, and he had a big birthday party and invited a bunch of people, rented out a boat. And on the second floor of this boat, there was like a casino. And Michael would walk around, and he would help, like, he was mathematically one of the smartest guys I mean, holistically smart, really out there making a difference in the world, but also just ridiculously sharp and smart. And so we'd be at the craps table or whatever table, and he would always, it was pretty funny because you'd have some guys who kind of thought they knew what they were doing, and, kind of chest out, trying to impress the girls or whatever. And he'd walk up and he'd kind of coach, whoever was the underdog at the table. And you're like, uh-oh. I want him on my team, but such an amazing guy. You're right. I mean, seeing that disconnect of capital back in the day, and to your point about value, I mean, with his miter light on the bus, reading financials, he wasn't speculating. He wasn't saying, I think this company might be successful in the future. He was saying, if you look at the numbers, it's got the cash flow to support it. It's got the assets to support it. It's just not it's just that the big sources of capital, they're not serving these companies right now. And I will. And in the process, he invented a whole, genre of financing, and I think did a lot of good for America, because a lot of those companies grew and created a lot of jobs that wouldn't have happened without that funding.
I'm actually part of the Milken Institute Young Leaders Circle, and go to the Milken conference every year. And I agree with you. I mean, the stuff that they're doing is just incredible.
I didn't know that, actually. What a small world.
Yeah. It's and I'm in Santa Monica, and the
around the corner from, sure.
Yeah, it's great, but it's amazing the impact they're having. It's special to be part of it in many ways, and it's going to keep growing. I mean, some of the things that they're doing now that I was looking at the conference this year, it's kind of mind-boggling. So, we're out of time, unfortunately. I feel like we could talk all day. This has been fantastic. I've loved it. I've learned a lot. And I wanted to ask you, what's the best way for folks to reach out to you, to learn about you? Is it LinkedIn? Is it a website? What's best?
Yeah, it could be LinkedIn, or you can look us up online at Whitwell advisors.com. And, always open to having open conversations and getting to know new people. So don't be shy, reach out. And again, thank you for setting this up. I've really enjoyed our conversation and feel like we could extend it for another 12 hours.
Yeah, we will offline. So everybody else will miss that, but maybe we'll do another one later to talk about all the advances that are happening now. Right. I mean, there's so much going on that we're going to have to talk about, 6 months, 12 months from now. So we'll get you back on.
Exciting times right now.
Well, thanks again for coming, and thanks everybody for listening to the 7 and 7 show with Zach Ellison. See you next time.